If you're not sure fixed rate is right for you, if you maybe understand finances a little bit better, have a little bit of money that's coming to you but not quite right now, or maybe even the rate environment is high but looks like it may go down in the future, then adjustable rate could be for you, but it's not for the faint of heart.
That's right.
This is Jeremy from Cheyenne Insurance. I'm with Ryan Langley, Vice President, Branch Manager of Ruoff Mortgage here in Bloomington, Indiana, and a mortgage lender that knows a ton about how mortgages work. And I just wanted to ask him one simple question. What is the difference between an adjustable rate mortgage and a fixed rate mortgage? And I guess kind of a secondary question, who is each one right for? So Ryan, welcome. We're super happy to have you.
Thanks for having me.
Cool. So how do these two different kinds of mortgages work?
Yeah, no, we can certainly start with the adjustable rate mortgage. Seldom used, often overlooked in today's environment as a very good mortgage option, but it's got to be for the right individual, right circumstances. We can start, for example, with a 5-1 adjustable rate mortgage, so a 5-1 ARM for short. And really all that is for the first 5 years of the mortgage lifespan, the rate is fixed. And now the payments are going to be based off of a 30-year amortization table. But for the first 5 years, guaranteed on that rate, it won't move until possibly year 6. So month 61 is when the rates could go up. So that rate is going to be tied to oftentimes the LIBOR rate. And right now we're in a rising rate environment. So there's very good chance that those adjustable rate mortgage loans may start with a very good rate, but in year 6, if rates continue to rise, you may see that rate go from, let's say, for example, if they're 4% now, you may see it go from 4% to 6%.
So let me see if I can just get a couple things straight. So when we say adjustable rate, that means that over the course of a given loan, let's use 30 years as an example, that rate could change. The interest rate you're paying to the bank for loaning you the money could change over the course of the loan. Whereas a fixed rate mortgage, you're making a decision at the very beginning that fixes that rate, keeps it the same through the course of that whole loan. So that's the basic language, right?
That is the basic language.
And so you're talking about adjustable rates that can change, and a lot of those start with a 5-year fixed rate. So you're going to have a certain rate for 5 years.
There's a lot of different structures for the ARM. There are 1-1 ARMs, there's 3-1 ARMs, 5-1, 7-1, 10-1, and there's a variety of different methods or different programs out there for the adjustable rate mortgages.
Okay. And adjustable rate has the positive effect of what? What could be a positive to an adjustable rate?
Well, the positive is that most often the rate's going to be lower than a fixed rate to start.
Okay.
They're going to start you out at a lower rate, but there's going to be the caveat that rates could go up. Doesn't necessarily mean that they will go up, but they could go up. And oftentimes now, ever since we've had a lot of changes in our industry since 2007, 2008, where these were very common and used quite often with the adjustable rate mortgages, but they didn't have the caps on them that they do now. So, for example, using our example of 4%, let's say in year 6 of a 5-1 ARM, that rate could potentially go up to 6%. Well, it may have a lifetime cap of going up 5% total. So it may have a lifetime cap of it of 9%. So you don't get in a situation where all of a sudden your mortgage turns into an 18-19% mortgage.
And that's what was happening before 2000.
In some circumstances, things
Interesting.
like that.
So adjustable rates sound to me to be a little more risky. Would that be fair to say?
They definitely come with more risk. There's a reward, which would be the lower interest rate for a set period of time, but they definitely come with a little bit more risk.
Who is the person that the adjustable rate mortgage is for?
Sure. Another example would be a first-time home buyer that knows that the home that they're buying is a stepping stone to the next home. They don't plan to be there for more than 3 or 4 years. It's a great loan program for that situation. Say as somebody that moves jobs frequently, that is just in the next stage of their career, they're going to be here for 5 years. They want to do a 7-year adjustable rate mortgage because they know that the rates are going to be lower. It's going to save them money on their monthly payments. And then they are going to be leaving. So you're talking about a loan program that's, if we had to put a percentage of the populace that uses it, 5%.
Okay.
You hear negative things about them. That's a very good loan program when used the right way.
Okay. And let's talk about fixed rate mortgages. What is a fixed rate mortgage?
Exactly like it sounds. You come in, 30-year rates are what they are. Let's say that they're at 4.25 or 4.5%. You are locked into that rate for the life of the loan. So as long as you have it and are paying on that particular loan, that's exactly what it'll be. Cannot change, will not change. It'll stay that way forever.
So the positive
until the loan's paid off.
Right. So the positive of it is that it's predictable.
It's predictable.
And
it's safe.
What's the negative of it?
There's not too many negatives to a fixed rate mortgage, especially in a rate environment like we've been in, where they're so low historically. You may miss out on some of the savings that you would have in the first 5 years on a adjustable rate mortgage, but over the long run, if you're doing a 30-year fixed mortgage, which is the most common mortgage out there, if you're doing a 30-year at the low rates of what they are right now, the predictability of it, you can't beat it. And it's the safest mortgage out there. You know exactly what that payment's going to be month in, month out, never going to change. It just gives you that sense of security, I guess, that you know what it's going to be.
And you said about 95% of people choose fixed rate mortgages. Is that?
Oh yeah.
Okay.
Yeah, cool. I would say, and that's a purely a guess.
Sure.
I don't have any statistical data to back that up.
But if you're not sure fixed rate is right for you, if you maybe understand finances a little bit better, have a little bit of money that's coming to you but not quite right now, or maybe even the rate environment is high but looks like it may go down in the future, then adjustable rate could be for you, but it's not for the faint of heart.
That's right.
All right, cool. Well, Ryan, thank you so much. If folks want to find you, where can they find you?
Absolutely. So you can call our Bloomington office at 812-650-3800. We can also be found online at www.ruoff.com. That is RUOFF.com. Or you can reach me by email at ryan.langley@ruoff.com.
Ryan, thank you so much.
Thanks for having me.
If you enjoyed this video and you feel like you want to learn more about the new home buying process, we've got another perfect video for you. If you go to our YouTube channel and check out the New Home Buyer's Guide, it lays out from beginning to end the whole process, from thinking that you want to buy a house all the way through the purchase process and the closing, and even talks a little bit about your mortgage payment afterwards. So definitely go and check that video out. And then, of course, please subscribe to our channel. We love to put out great information for you. We're happy to have it in your inbox as soon as it goes live, and you can check it out and learn from it. And of course, if you feel like great things are happening at this channel, please do share on your social networks. All right, until the next time, have a wonderful day.